So, property criteria. It's a wide universe. We've got Canada and the US that we're looking at, the Canadian LP and the US LP. This map shows us where we have assets, and I've already talked to you about Steinbach, Manitoba. Excluding Steinbach, all the other cities that are shown on the map are large or major markets. So we have got a good selection of properties, but how do we end up choosing the properties that we choose? Where are the markets that we go into? I had a whole bunch of slides that I had to eliminate for the time that's available to me this evening, but each of the markets that we're in have a story, and are markets that are growth markets, are markets that are worth investing in, not only for the short term, but also for the long term. So we want to make sure that our property criteria are aligned with our investors' objectives and our management focus. So location. We talk about A locations, major growth markets in Canada and the US. The product, you'll see from some of the pictures that I'm going to show you, it's often what we refer to as B assets, but it's in the retail, the office, the industrial, the self-storage, and in the US in the multifamily. We don't buy houses, we don't do land development, we don't do hotels. We're really focused on the type of assets that we'll acquire. Tenant mix, we want to have a strong, balanced, and complementary across our portfolio. We look at each asset and it's got to stand on its own 2 feet as an individual asset, but then we look at what it does to contribute to the overall portfolio. So tenant mix is important. The maintenance of capital. When we receive rents, that rent goes to pay the mortgage payment. It also goes to pay the repairs and maintenance to make sure that the assets are looked after. Because we're long-term holders, we want to make sure that those assets will last and produce for us over the long term. So we want to make sure that we address deferred maintenance. We want to make sure that we've got proper capital reserves. We want to make sure that we look after those assets well for the long term. Income, we want it derived from growing tenant rents. The leasing agents, people that we talk to for renting, I'm saying, I don't want to have a flat 5-year rent. Just give me a little bit extra rent each year. Just a little bit of rental increase each year. Grow that cash flow. Keep it stable. Find a value add strategy. I gave you a couple examples just a couple minutes ago. And occupancy. Both individually within our assets and across our portfolio, we want to stagger the lease maturities so that we can maintain that high occupancy. Another brief case study. This is an asset that we acquired in Toronto. It was our first asset in the Greater Toronto area. Acquired August of this year. Note the cap rate. We're into the 6s. So we've gone from the 9s to the 8s to the 6s. Declining interest rates, moving into more major markets, moving up or moving down the risk spectrum means also a lower cap rate. Why we like this particular asset. The GTA is the largest market in Canada. We've grown to a size now that we need to be in the Toronto market. But where do we want to be in the Toronto market? Pearson International Airport, largest airport in Canada, industrial market. I refer to this as boring industrial. Boring industrial is good. They're business owners. They don't really care too much what it looks like. Is it functional? Is it working for them? They can conduct their business. They can stay there over the long term. There's costs every time you put in new tenants, every time you have to add tenant improvements to a property. So if we can get boring industrial and have tenants stay in there for the long time, over the long term, that's going to really help us with our cash flow and our rents. So B assets in near Canada's largest airport. Strong leasing market. The occupancy is moving up. The vacancy is trending down. What we liked about this asset, we were also, and the cap rate is actually a little bit higher than that because part of our negotiation and price was we negotiated, I think, off the top of my head, about a $3.5 million capital reserve that we're going to invest back in the property to keep the property well maintained. So that's part of what we negotiated, and that will ensure that the property is well maintained over the long term. Are there still opportunities out there? As a preferred buyer, deals come across our desk every day. We have built over the last 13 years a great reputation and track record that has sellers coming to us. We're known to have available capital and a good closing record. People want to come and deal with us. We get a chance to see what's on the, what's available in the marketplace. What we're looking for is what I refer to as mispriced assets. That includes off-market deals where it hasn't come to market, and there's usually a number of reasons for why people don't want to bring an asset to market. But by not bringing it to market, sometimes there's opportunity for us to see value and recognize value that maybe the sellers don't. Motivated seller, I'm going to give you an example here in a sec of a motivated seller. They needed to sell the property before the end of the year. They knew that we could close, and we've got a good closing record, and we had capital available, so they wanted to deal with us. And deal fatigue. Sometimes properties get on the market, and they just get tired. They've come to the market overpriced. People look at it, they don't respond, property gets tired. We've looked at it, and we come in, and I've got an example of one of those here in a sec. And then there's what I call the 2% ratio. Of every 100 properties that we look at, 80% of them get eliminated right away because they're in the wrong market, they're the wrong type of asset. But the 20% that's left, we go and we have a look, we do some due diligence, and of those 20, there's about 8 that we'll actually write an offer on. But before we write an offer, we've got to do substantial due diligence, because if they accept our offer, our reputation is really important and we want to close. So we're doing appraisals, we're doing building condition reports, we're doing financing, we're interviewing tenants, we're doing a whole lot of due diligence to make sure that we're really comfortable, should the offer be accepted, that we will close. Of the 8 that we offer on, 2 we end up with accepted offers that are on terms that are acceptable to us, and of those 2, we have a track record of closing pretty much 100% of those. Examples of a couple of properties that we're currently buying and why. I've only got time this evening to talk about 2. I'm going to talk about an industrial property in Seattle and an apartment property in Houston, Texas. The one in Seattle we refer to as Norfolk Industrial. If you know I-5 and you know where Boeing Field is, and if you travel down south a lot, you'll know where Lindell Cedar Homes. We're right in that node. It's an industrial property. We're acquiring at a 6.4 cap rate. Why do we like it? The location is strong. It's an infill location. Seattle, not dissimilar to Vancouver. The industrial supply is being reduced by other uses, whether it's condos, whether it's stadiums, and businesses want to locate near the city. And in this particular case, we have 2 strong tenants that don't want to be way south of Seattle. They want to be as close in as they can be. This particular property, in addition to the land, we also have a right of first refusal on the adjoining piece of property, which is used by the major tenant. There's a diminishing supply of industrial land, which I'd mentioned. This is a deal that had deal fatigue. When we heard about it, it had gone to market. It had been priced too high. People weren't looking at it. We came in, we assessed it, we looked at it, and we came in with a much lower price, but we were a known buyer. We'd bought other properties from people that were related to this seller, and they chose to deal with us. And we've got a great asset in a solid market that's got stable cash flow. 73% of the tenants are likely to continue to be there for the long term.